Have you ever paid taxes on your own money twice? Imagine this. You build a business from scratch, you work your tail off, make a solid profit, and the government says,
"Thanks, we'll tax the company for making money, and we'll also tax you for receiving that money. Love, Uncle Sam."
That's double taxation, and unless you're into financial masochism, it's probably something you want to avoid. Meet Melissa. Melissa runs a booming cupcake business and goes through all the steps to make it official. She files her articles of incorporation, sets up a board, gets an EIN, the whole 9 yards. Melissa is now the proud owner of a C Corporation. Great, right? Well, yes. And no. Here's how it works. Her shop makes $100,000 in profit. The C Corp pays corporate income tax on that $100,000. Then, Melissa wants to take that money home, so the C Corp distributes the profit to her as a dividend. Melissa gets taxed again on that dividend as personal income. Same money, taxed twice. Once at the corporate level, once at the personal level. It's like ordering fries and getting charged once for being able to hold them, and then again because you also want to eat them. But there's a way around this corporate double taxation issue for Melissa and her cupcake shop. An S Corp is like the cool cousin of the C Corp. It gives you all the asset protection of a corporation without that double tax frustration. Profits and losses of an S Corp flow through to the owner's personal tax returns. The business itself doesn't pay federal income tax. Only its owners do. So Melissa's shop makes $100,000, and Melissa just reports that income on her personal return. No corporate level tax. Now, this isn't a free-for-all. To qualify for an S Corp status, there are some fine print rules. Most notably, you have to be a US citizen or resident, the business can't have more than 100 shareholders, and it's limited to only one class of stock, and all those shareholders have to be individuals, so no corporations or partnerships as owners. Still, for a solo or small business owner like Melissa, that's usually not a problem at all. Now, you might be thinking, what if I'm not a corporation at all and don't want to be? Well, then an LLC, or a limited liability company, might be the perfect fit for you. An LLC is not taxed as its own entity by default. Instead, it acts like a partnership or sole proprietorship with flow-through taxation and limited liability included. In fact, an LLC can elect to be taxed as an S Corp if that makes more sense for you and your tax planning. Think of LLCs like the customizable Lego set of business entities. Just enough structure and instruction, but you can still build it your own way if you want to. So what did Melissa do? She filed an S Corp election with the IRS and went from being double taxed to just regular taxed. So now more of her profits go toward expanding her shop, hiring a second baker, and finally splurging on that industrial mixer she's been eyeing. The moral of the story is that you need to choose your business entity like you choose your roommate, with caution, clarity, and a close look at who's paying the bills. Having a lawyer and a CPA in your phone book can be extremely helpful to address any questions and concerns you have related to what structure is best for your specific business and goals. If you're running a business and haven't thought about how you're taxed, there's a good chance you're paying more than you need to. A little paperwork now can save you thousands later and keep your cupcakes or consulting fees, content creation empire, or whatever else it might be from funding 2 rounds of tax instead of just 1. So you just won a foreclosure auction. You're strutting out thinking, I just beat the system. But plot twist, the system might have just sold you someone else's mortgage bill.